Hey everyone, welcome back to the channel. Today we're diving into a topic that every Canadian resident needs to know about, the RRSP or Registered Retirement Savings Plan. Whether you're just starting your financial journey or looking to boost your savings game, this video is for you. Let's break down everything you need to know about RRSPs. So what exactly is a RRSP? Registered Retirement Savings Plan is a registered account, which means it is registered with the Canada Revenue Agency, CRA, and follows specific rules set by the government. The government gives it a tax-advantaged status, meaning the money you contribute can be deducted from your income to help reduce the taxes you pay today. Plus, the investments in your RRSP can grow tax-free until you withdraw. Pretty cool, right? To really understand the tax advantage of an RRSP, let's break it down with a simple example. Imagine you earn $80,000 a year and live in Ontario. Without contributing to an RRSP, you'd be taxed based on that full $80,000 income. But let's say you decide to contribute $10,000 to your RRSP this year. This $10,000 is deducted from your taxable income. So instead of being taxed on $80,000, you're now only taxed on $70,000. In Ontario, that could save you about $3,000 in taxes, depending on your tax bracket. In short, contributing to your RRSP not only helps you save for retirement, but also lowers the amount of income tax you pay right now. One of the great things about a RRSP is its flexibility. You're not limited to just keeping cash in the account. You can invest in stocks, bonds, ETFs, mutual funds, GICs, and more. This makes it a versatile tool whether you're looking to grow your wealth through investing or keep your money safe in savings products. Now, how exactly is your contribution room calculated? Well, each year it's based on 18% of your earned income from the previous year, up to a certain limit that the government sets. For example, in 2024, the contribution limit is $31,560. So, if 18% of your income is higher than that, you can only contribute up to $31,560. If it's lower, then your limit will be 18% of your income. And remember, unused contribution room carries forward to future years, so you don't lose it if you don't contribute the full amount this year. Wondering how much your contribution room is? It's easy. You can find your personal limit on your Notice of Assessment from the Canada Revenue Agency, CRA, or by logging into your CRA online account. Now, what if you accidentally contribute more than your RRSP limit for the year? It's important to be mindful of your contribution room because over-contributing can lead to penalties. Here's how it works. The Canada Revenue Agency, CRA, allows a small over-contribution buffer of $2,000 over your limit without any penalties. However, this extra $2,000 won't give you any tax deductions for the current year. It's simply there to give you a little flexibility in case you make a mistake. If you contribute more than $2,000 over your limit, you'll face a penalty. The CRA charges 1% per month on the amount that exceeds your contribution limit by more than $2,000. This penalty continues to apply for every month the excess contribution remains in your RRSP account. So be careful. You might be thinking, when can I actually take the money out? Great question. You can withdraw money from your RRSP at any time, but here's the catch. The amount you take out is subject to taxes. The idea is to wait until retirement when you'll likely be in a lower tax bracket. This way, you pay less tax when you finally start withdrawing from the account. Now, what happens if you need to withdraw money from your RRSP before retirement? Let's break it down with an example to understand how taxes work in this situation. If you withdraw money from your RRSP before retirement, you'll face withholding tax, and the amount withdrawn is also added to your taxable income for the year. The withholding tax rate depends on how much you withdraw and whether you're in Quebec or another province. Here's a breakdown for most provinces in Canada. Up to $5,000, 10% withholding tax. $5,001 to $15,000, 20% withholding tax. Over $15,000, 30% withholding tax. For example, let's say you withdraw $10,000 from your RRSP and you live in Ontario. Here's how it would work. Since $10,000 falls in the $5,001 to $15,000 range, a 20% withholding tax is applied. 20% of $10,000 equals $2,000. So your financial institution will automatically deduct $2,000 from the withdrawal and you'll receive $8,000. The full $10,000 is also added to your taxable income for the year. Let's assume you're in a 30% income tax bracket. At tax time, you might owe an additional 30% on the $10,000, which is $3,000. You already had $2,000 withheld, but your total tax on the withdrawal is $3,000. So, when you file your taxes, you may owe another $1,000, $3,000 total tax minus the $2,000 already withheld. And if you withdraw from your RRSP before retirement, something important happens. You lose that contribution room. That means you can't recontribute the money you withdrew, and your total limit shrinks. So if you can, it's best to leave that money in there until you really need it. So what happens when you withdraw from your RRSP after you retire? Unlike early withdrawals, there's no withholding tax when you convert your RRSP into a registered retirement income fund, RRIF, or start withdrawing in retirement. But here's the key thing to remember. The money you withdraw is still taxed as regular income. When you retire, you'll likely be in a lower tax bracket than when you were working, which means you'll pay less tax on your withdrawals than you would while employed. The amount of tax you pay depends on your total income in retirement. Let's go through an example. Imagine you're retired and living in Ontario. You decide to withdraw $30,000 from your RRIF. If your total retirement income for the year, including pensions, is $50,000, this $30,000 will be added to your total income, bringing it up to $80,000 for the year. At this income level, your marginal tax rate might be around 29.65%, depending on the year and tax rates. So you'd pay approximately $8,895 in taxes on that $30,000 withdrawal. However, because you're retired, this total income is likely much lower than what you were earning during your working years, so your overall tax burden is reduced. Opening an RRSP account is really simple. You can do it through most financial institutions, including banks, credit unions, or online brokerages. To open an RRSP, you must be a Canadian resident, have earned income, and be under 71 years old. You can contribute to an RRSP up until the end of the year you turn 71. After that, you're required to convert your RRSP into a registered retirement income fund, RIF, or annuity to begin withdrawing. And that's the scoop on RRSPs. It's an amazing tool for Canadian residents to save for retirement while getting some tax benefits along the way. Remember to take advantage of your contribution room and be mindful when withdrawing. Don't forget to like, subscribe, and hit the bell to stay updated on all things personal finance. See you soon.